Hello, everybody. Welcome back to the latest episode at Walk of Wealth. I'm a Dr. Johnny with Adachi. If you haven't met before, I'm an endodontist, part-time endodontist. I'm a full-time passive investor. We've raised and successfully deployed over $20 million of capital across commercial real estate, oil and gas, private equity, debt funds, and most importantly, we've really helped dentists to make their first. We've helped over 150 dentists now invest passively in these alternative spaces. We've also seen not just our investors, many investors have gotten hurt, especially investing in multifamily over the last few years. A lot of people have been turned off, right? We saw people walk away. I'll never do this again. Like I would have rather stayed in the stock. If I would have just stayed in the stock market and never done any of this, none of this would have happened. And we're seeing a lot of that. But this might be the worst time to be doing that because now is when we're seeing the tremendous opportunity. When everybody is turned away and looking away. And I'm joined today by a very special guest, our Chief Investment Officer at ASYM Capital, good friend of mine, business partner as well in a multifamily project in Phoenix. And Tyler has a very amazing story. And Tyler, I'm not going to steal your thunder, but now Tyler is was in his former life a very renowned CPA, and now he's transitioned into a general partner role at ASYM Capital, where they are acquiring multifamily real estate, and they specialize in Phoenix. Now, Tyler, before we jump into the meat and potatoes of our conversation, give us a little bit of background and fill in the gaps that I missed.
Johnny, it's good to see you, my friend. I'm really excited to be on here today and to be able to share information with you and your group. Great to see you, and it's great hearing you tell a little bit about your story and the money that you've raised and the success you've had too, because you've grown a lot since we met just a few years ago. So kudos, brother. It's been awesome to see your progress. But yeah, I'm Tyler Lyons. I'm the Chief Investment Officer at ASYM Capital. As you alluded to, I was originally a CPA by trade before I got into the real estate space. And I kind of, in a way, lucked my way into the real estate world. In a way, it was intentional and kind of through some research. But kind of going back to my career, got my degree in accounting, got my CPA right away, and kind of started climbing the corporate ladder in the world of corporate finance. I worked for a large public accounting firm first. Then after that, I worked for a large publicly traded manufacturing company. And I was pretty much climbing the ladder to try to become a CFO someday. Like that was my North Star professionally. That's what I wanted to go after. And after grinding it out, getting some early promotions, I had, quite a bit of success early on in my career. I started to realize that, you get 13, 14, 15 years into a career, and I started to realize, man, this isn't really what it's all cracked up to be. I don't know if this really is what I want. I started coming to that realization, and that can be kind of scary after you've poured your blood, sweat, and tears into a career over that much time. So that kicked off a lot of soul searching on my side, reading a lot of books, listening to a lot of podcasts, really trying to get serious about what I really want to do with myself professionally. And I just happened to find real estate. I stumbled across a website called Bigger Pockets. Some people may have also started investing in real estate, kind of checking out Bigger Pockets as well. So I dove deep into the podcast space and learned everything that I could. And I just started buying small residential properties using my own money. First a duplex, then a fourplex, a couple of single families. And what you realize pretty soon is A, you run out of your own money pretty quick, unless you're just independently very wealthy. And B, buying smaller residential properties like that, it's not the most scalable thing in the world, because what I wanted to do and what I realized pretty early on with real estate is that I loved it. I was passionate about it and I wanted to do it at a bigger level. But to get to like 100 units just buying onesie, twosie deals using my own money, it would have taken me decades to do it. So the next level for me was I found the world of investing in syndications. So I started investing passively in private placements several years ago. And that was another realization for me where it's like, man, with my institutional CPA background, I feel like I could do this professionally. So I started diving down the rabbit hole and started trying to do my own deals and realized that raising money is very difficult if you don't have a background doing it. And I just so happened to come across who's now my business partner, a gentleman named Hunter Thompson. kind of got into his circle and started to learn how to raise capital from him. And eventually, him and I became business partners. And it was one of those things that was a really good partnership because, I'm kind of more of the analytical CPA guy, more of underwriting and asset management. And he's really good at raising money and marketing, that sort of thing. So it's really one of those 1 + 1 = 3 sort of scenarios. So I joined his firm, ASYM Capital, back in 2021, and it's been super exciting. It's been a ton of fun, kind of getting out of the typical W-2 world. Now I'm a partner at ASYM Capital. We co-own the business together, and we focus on buying apartment buildings in Phoenix. We made a bit of a strategic shift to focus just on Phoenix multifamily back in 2023. And since that time period, we've purchased 4 buildings, about $63 million of assets under management. And we're really excited about where we sit in the market cycle right now and the opportunity that we have to buy multifamily deals at a very attractive basis. So I know before we got on here today, Johnny, we talked a bit about what we view at ASYM Capital as potentially what we're calling internally the trade of the decade. And looking forward to diving into that with you a bit more here today.
Yeah, that's great. Now, this topic is this video is titled "Why Multifamily Might Be the Trade of the Decade." But before we can say that, I wanna ask, I'll give you a little bit of pushback. Now, we've as doctors, we've heard this story before, right? So what happened we've heard that multifamily is a can't miss investment. It's great and how great it is, and how, conservation of capital and all of these things. This was 2020, 2021, very early on in Walk of Wealth's origin time. And then all of a sudden, we had capital calls. We had some people had foreclosures where they've lost their money. Some people have had, many have had paused distributions. So why should we believe you? And I'm not saying you, I'm saying you multifamily people. Why should we believe you this time? And why is it that this is the trade of the decade after? So before we can talk about the trade of the decade, what happened to multifamily? Why did it not what we thought it was going to be?
Yeah, it's a great question. Yeah, it's when you're in the moment and making investment decisions, you're attempting to make investment decisions with the information that you have at your fingertips. You're trying to understand, what's the market like, what direction is it going? There's a lot that kind of goes into it. And where we sit here today in 2026, it's kind of easy to look back and do a post-mortem now and be like, oh shoot, like I wish I would have known this, I wish I would have known that. But when you're in the heat of the moment and you're in the middle of 2021 and the market's frothy and everybody's making money and doubling their money in multifamily investments, when you're in the heat of the moment, that's when it's difficult to make the right decision. Like it's easy to look back now and be like, well, shoot, of course I should have known. But when you're in the moment and kind of like it's one of those like everybody's doing it, you get some herd mentality going on. That's when it's difficult to make the right decision. So when I kind of look back at the run up in the market and kind of what essentially kind of quote unquote what happened, we had a few different things going on. I mean, one was COVID-19 came through. And as a result of COVID-19, the powers that be kind of shut the global economy down for a period of time. And after the economy got shut down for a period of time, in response, the Federal Reserve reduced interest rates really low to basically 0%. So now you've created a situation where you have really cheap money. So, okay, that's like one data point. We had these historically low interest rates. We've got really cheap money. And if people have cheap money, if the cost of money effectively becomes zero, it basically creates more risk-taking behavior. If you think back to it, there are people, kind of putting money into NFTs and meme stocks and crypto, like everything was booming.
Virtual
then,
worlds.
Right? Yeah, totally. It wasn't just multifamily.
Meta.
All these things all these things really took off. So that was like a big part of it. This low interest rate environment that was artificially created this kind of interesting and unique environment where money was basically free. So people are going to go borrow money and risk it to invest. That was a big part of it. And then another thing that was interesting in COVID as well, it was a situation where you had some stimulus that went directly to consumers. Up until that point in time, we really hadn't seen stimulus go directly to consumers. It might be like a 2008 situation where, Wall Street's getting bailed out, that sort of thing. We've got stimulus going to like companies and that sort of thing. But when you get stimulus going directly to consumers, that also might entice some of this risk-taking behavior where it's like, okay,
Absolutely.
I've got an additional couple $1,000. I'm going to toss this into Bitcoin, or maybe I'm going to move into my own apartment building. You know what I mean? Now I've got some of the stimulus coming to me. Maybe I'm going to get my own place now. But then
Hmm.
also the work from home situation really created a boom in single family homes. A lot of people went and bought single family homes during that situation. It's like, hey, I can work from home now. I can get a really low mortgage. As a result, we saw single family home prices boom, and they've not really come back down. They've continued to be stubbornly high. But then,
Yep.
similar in the multifamily space, too, we saw people maybe move out and go get their own apartment unit. So, in addition, we saw this boom in consumer demand for multifamily as well. And with this boom in consumer demand, especially you had a lot of people moving across the country during COVID-19. Remember that? Like people were moving from California and New York, and they were going to Arizona and Florida and places that were more free because they didn't want to be forced to be locked inside. So you've got people with more money now. You got people moving into different geographies. You got people moving into their own homes. And as a result of that, we saw a crazy amount of rent growth in various different markets in the multifamily space. I remember peak rent growth, I think it was mid 2021 in Phoenix. We saw over
70,
20% year over year rent
20%.
growth
Yeah.
at one
Yeah.
time. It's crazy what we
Hmm.
saw.
Hmm.
So you saw this. Now, what you're also starting to see now is okay, developers are looking around, they're like, okay, I can basically borrow money for a really, really low
Free.
rate.
Yeah.
I see these crazy rent growth in these different markets. Now I'm going to go build.
Build. Yeah.
So now you've got, you know, a bunch of developers going and building and creating a bunch of new supply. So, you kind of step back and look at it. And then also on top of it, people who are buying it wasn't just developers. Like that's part of the story though, right? The developers started building, then we got this big supply boom. But then people were buying existing multifamily deals using that cheap money as well. It's like, okay, if the interest rate is like 0%, of course it's a little bit higher than that for multifamily. It was back then. There's some spread above the Fed funds rate, but the Fed funds rate was basically zero. So now you've got people out there levering up and taking on a bunch of really cheap debt to go buy these deals using high growth rate assumptions because we saw this crazy high rent growth. That created a really big boom in terms of multifamily acquisitions. Now, part of that story too is that the people who borrowed the money at these low interest rates to buy these deals, um, it was typically 3 year debt. It might be a 3 year debt with a plus one and a plus one, but to get the plus ones, you got to hit certain debt yield requirements. And as the market started to kind of bounce back the other way, all of the supply that was built started to come to market. That put downward pressure on rent growth.
Rent. Hmm.
That was a big part of the story. And then you had people kind of getting to the end of these 3 year terms, and now it's like, well, our rent growth went down. Expenses were kind of going up during that period of time as well. The insurance market was pretty tight during that time, so insurance costs were going up, rent was going down, and then you get people to the end of the term of this 3 year short term debt. And now they can't refinance because now interest rates bounced up in 2022. So you get into 2022, we're starting to hit all this inflation. Now interest rates go way up because the Fed wanted to combat inflation. So now people are trying to refinance after that 3 year debt. Interest rates are way higher. And when interest rates go up, multifamily valuations typically go the other way. So then people really struggle to refinance. And then you're getting the capital calls, then you're getting the foreclosures, then you're getting the issues. So just I know that's a bit of a long rant, but at a high level, like that's kind of what we saw happen in the multifamily space, call it from 2021 and we're still seeing some of the effects of it just kind of resolving itself still today. But those were some of the dynamics that caused a lot of investors issues and a bit of pain the last few years here.
Yeah, absolutely. That was a great post-mortem analysis. Yeah, thank you for that. So Now, why why did this create opportunity? Why is there opportunity now, right? Like, what are you seeing differently? To
Yeah.
and what? How do we avoid what happened in the past?
Yeah, let's talk about some data points that I think are going to be really helpful for people. First of all, we've seen a complete reset in the pricing in the multifamily market that's fairly historic. So when we saw interest rates go way up in 2022 when the Fed cranked them up to fight inflation, now mind you, that would have been tough for anybody. That's tough to predict. You're buying a deal in 2021. I mean, who would have known in 2021 the interest rate, the Fed funds rate was basically going to go from 0 to like 5% in like a little over a year.
11
Yep.
straight rate hikes in a 17-month period or something, which was historic um, interest rate jump, right? They never jumped that
Yeah.
high since the 70s, I think 80s when Paul Volcker raised it to 22%.
Yeah.
Yeah, that
100%,
never
man.
happened. So
So,
hard to predict that. That
yeah. I mean,
when historic things happen is very difficult. Yeah, okay, so yes, I can concede that.
yeah, some of the most brilliant minds in finance didn't see that coming, And it's like if you're in a multifamily deal and that happens to interest rates, like that's really tough. That's really tough to just absorb.
Yep.
So now you might push back and say, well, Tyler, I mean, cap rates were really, really low, meaning valuations were really, really high during that time period. I mean, shouldn't investors have known that valuations were a bit frothy at that point in time and maybe pulled back a little bit? I mean, I would say that's fair. But yes, I mean, at the same time, just the extent of interest rate increases that we saw would have been very difficult to predict. Now, in the wake of that, what we've seen, Johnny, is we've seen a significant historical correction in multifamily valuations. For example, in some of these Sunbelt markets, it's not an exaggeration to say we've seen multifamily valuations correct from the peak, which would have been, mid 2021 to maybe start of 2022, 30% correction, peak to
Mm,
trough in valuations. To
mm.
give you an interesting data point that I think is kind of a microcosm of what we saw, the deal that we just bought back in November of 2025, we bought it for 185,000 a door. Awesome Class B bread and butter multifamily deal right in the heart of Tempe, Arizona, which is kind of, they call it the Silicon Desert. It's just completely booming. The deal across the street at the peak of the market cycle in early 2022 sold for 300,000 a door.
Wow.
So we bought this deal for roughly a 38% discount compared to peak market
Peak
pricing.
pricing. Mm.
I know that doesn't like fully answer your question, but like that's a data point you can look at and be like, wow, like we're completely in a different area now. But some of the things I think people can look at so that you can try to play some defense in the future, like when the market gets frothy again. We'll talk about why the market is not frothy. We're seeing the opposite of froth right now, which historically speaking means it's a good time to buy. But for example, like one thing you can look at is transaction volume is a really strong indicator of market froth and market peak. And when you look back at what we saw, during 2021 and 2022, we saw all-time highs in transaction volume. And when you see all-time highs in transaction volume, what does that mean? It means you have a lot of different investors and a lot of money chasing a limited amount of deals and driving up the price.
Mhm.
So looking at something like transaction volume, looking at something like debt financing as well, like what's the readily available amount of debt financing? Because that's another thing where bridge lenders are willing to be really aggressive and let people buy these deals for like 80% loan to value, 85% loan to value. Now we've completely swung the other way where it's a lot harder to get debt financing. The lenders are pulling back a bit. You can't get as much loan to value. Going through an agency underwriting right now is really onerous and difficult. They're really
Mm.
scrutinizing general partners to a very deep degree. So that's kind of swung the other way. I mean, just again, another data point. The last two deals that we bought, 60% loan to value and 65% loan to value. So those are a couple of things that I think are, kind of somewhat leading indicators and good data that you can look at to understand the frothiness of a market and to allow yourself to play a little bit of defense and understand a little bit better where we're at in the market cycle.
Yeah, I mean, so you know, how do we now? You're saying that things aren't frothy right now, right? Things aren't so rosy right now. Um, we have a slowing economy. Inflation is starting to really tick up. Even excluding gas energy prices, inflation was starting to tick up. Like a lot of these tariffs, and I think it's still a lag in seeing the effects of tariffs on the industry. We have, immigration policy of the administration. All of these things really play heavily in the multifamily space, right? They directly impact multifamily. Um, the credit financing, right? Loan proceeds are down, LTVs are down. So how does this create opportunity though?
Yeah. Yeah, it's a really good question. So if you step back and look at the data, um, a couple of things we just touched on, like the transaction volume, like that's way down. That's historically significant. And if you look at history, when transaction volume is way down, that usually indicates that's a good time to buy. I mean, for example, look at 2008, look at 2009. Everybody would have loved to have to buy in 2008 and 2009. Problem was nobody could, right? Everybody was losing their jobs, everybody's losing their shirts, everybody was going bankrupt. You couldn't get a loan if you wanted to back then. So usually when it's harder to buy, that means transaction volume is going to be lower. And that's what we're facing right now, man. I mean, I know we talked a little bit before we jumped on around, look, you know, some people who have gotten burned. I know some people have gotten burned. I've personally been burned in some deals, right? Like it's that's part of the reason why now is a good time to buy because it's harder to get the debt. We talked about that, but it's harder to get the equity too. Because there are people who are a little bit gun shy right now with, you know what? I've been burned in multifamily before. I'm not going to do it again. But, you know, we're kind of in a situation now where the paradigm has really flipped the other way. The transaction volumes are way down. We're seeing supply completely falling off a cliff. Just to give you some data points around Phoenix, we had 15,000 deliveries in 2022, um, 18,000 in 2023, 26,000 in 2024, which was the peak. We had 15,000 last year. We're gonna have 12,000 this year. And then the couple years after that, we're expecting 8,000 and 5,000. And 8,000 and 5,000, like you're getting to a point now where it's below historical norms, yet we still have super strong population growth. The economy is booming like crazy here. We have things like Taiwan Semiconductor building the $165 billion manufacturing facility in the north of Phoenix, which is the biggest direct foreign investment in US history. It's going to be a city within a city up there. I know some people think that thing in and of itself is going to create 30,000 jobs. So we're in a situation now where the market is not only swinging into equilibrium, I believe it's going to be swinging into disequilibrium pretty soon here, with demand potentially outstripping supply. And when you think about rent growth, it's really just downstream from supply and demand. So in that situation where supply was outstripping demand, we lost rent growth. It was rent decline, right? But if you swing the other way, you start to get some pretty strong rent growth. So that's um, really interesting, really pertinent. Another thing that's really just very pertinent across the nation right now is this gap, this affordability gap between what it costs to actually to buy a single family home versus what it costs to rent your typical two-bedroom multifamily unit. Earlier, we were talking about how single family prices really went up significantly in the wake of COVID. But even though interest rates have gone up, we've not seen a corresponding decrease in single family housing prices, right? And a big part of that is because it's long-term debt. You know, you don't have people who buy these homes and are like, oh, shoot, I got to figure this out in 3 years. It's usually 30-year mortgages. So you have this massive gap right now in Phoenix. What it costs you to buy kind of your typical starter single family home, your monthly payment is over $2,600. And to rent your typical bread and butter two-bedroom unit, that's going to cost you over $1,400. So there's a spread of about $1,200 per month for families who, have to choose. It's like, hey, I got a limited budget. Am I going to go rent this apartment unit for 1,400, or am I going to go buy a single family home starter level and pay 2,600 per month? So you've got this massive affordability spread that is going to continue to be a tailwind for multifamily in a lot of these different markets. So that's another thing that really I think just gives a lot more, makes me a lot more bullish on the multifamily space as we move forward here.
Yeah, those are some great answers. So, supply demand, right? You talked about that. We had an excess supply in places like Phoenix, cheap capital, lots of builders came in, started overbuilding, created an artificial swing in supply that greatly increased supply faster than the demand. And this created downward pressure on rents, right? So now rents slowed down, things slowed down, values came down when interest rates went up. But those specific things, exact same things, are we're in the beginning. I believe we're in the beginning stage. That was late multifamily cycle. I believe we're in the ascendant start part of it. And this is when nobody's paying attention right now, right? Because of all of these aforementioned things, that's precisely the reason why there is opportunity.
100%.
There's a wall of debt that I believe that extend and pretend is not going to happen anymore, right? There's all these properties that people have under these floating rate. They extended it for a year by doing the capital call. Once once these banks get to a certain LTV, they're gonna be like, no more extend and pretend. Now we're calling the loan. Like you
Yeah.
gotta make a move now, right? Like we want to, and so I agree with you. I think that there's gonna be a wave of opportunity. There's gonna be distressed sellers. When you combine distressed sellers with less competition, right? Less investor capital chasing this. There's less operators chasing deals. There's less lenders lending on these deals. Well, the guys that can figure out a way to get these deals done and buy at a great basis, and you're saying 30% discounts in places like Phoenix, which are one of the most coveted, sort of markets, right? These Florida, Texas, a lot of the Sun Belt that slowed down. Well, the supply demand that you imbalance, well, there was an oversupply. Well, now interest rates came up, sentiment's down, there's less people building, and now it's gone the exact opposite way. Now you're saying the level of new delivery units are dwindling down. That in just 3-4 years from now, we'll have a dearth of new supply. And now all of a sudden, you still in these places like Phoenix, where you have tremendous job growth, you have tremendous population migration. I think the migration might have slowed down from the rates of 2020, but still growing at a rapid clip, lots of jobs, good diverse economy. And you're going to have all these people coming and competing for units that are not being delivered. So now all of a sudden you have an excess supply to having a supply imbalance where you have a shortage of supply. So the demand is now exceeding supply. And this is what puts upward pressure on rents. This is what puts upward pressure on NOI and ultimately valuations, even if it's at an expanded cap rate. So if you're buying at expanded cap rates, then and you have the debt that is appropriate, then I think you're very favorably positioned for when things turn around in 4 to 5 years. I mean, the macroeconomics and all point towards that.
Yeah.
So
It's a really good summary.
yeah, yeah, I think it's just really piggybacking on what you said. So now,
And if I could add
number
just
one,
one more, if I could
yeah,
just put a
sure,
finer point on one thing that you mentioned, I
yep,
think this is really important because it is important to acknowledge, like, I mean, we all get it. I mean, I'm super empathetic to the fact that people have been, had a rough go in multifamily, depending on when you enter the cycle. But you touched on something really important too when it comes to the debt. Like the debt part of it is so important because if you're investing in a frothy market and you're investing, with a high loan to value, and let's say the going in cap rate at the market peak was like 3% and the cost of your debt is like 4%, you're in a negative leverage scenario where the cost of your debt exceeds your going in cap rate and you've got short-term debt on top of it. It's a recipe for potential disaster if the market changes, which it did. Now, if you're in a situation like we are now where maybe you're buying a 6% cap rate deal and you have a 5.1% interest rate, you've got positive leverage and your loan to value is only 60% loan to value, and you've got 5 to 7 year fixed rate debt, it's so hard to get hurt in that particular instance. So just to put a finer point on just like how much different it looks like right now in the market cycle compared to what it looked like a few years ago.
Yep. Yep. Great point. So now we've gotten to the point, all right, where there's going to be lots of opportunity, distressed deals. So let's talk about, what separates good and bad deals. How are you guys finding these deals? What is important? Um, what is important about what makes it a good deal from a bad deal? How do you separate? What are you looking for? Um, what do the bones look like for an ideal acquisition for ASYM?
Yeah, it's a great question, and I'll warn you, some of this is kind of simple, but it's really good and it's really important because as we're looking through these deals, and if you're an LP out there looking to allocate capital, it can be so easy to get caught up in the narrative or the story of the deal, or the narrative or the story of the sponsor, and the spreadsheets and the exit cap rates and all these different metrics. It can be easy to get lost when we're doing acquisitions. Our first filter, the thing we bias for the very most, is location. The old trope of location, location, location is super important in multifamily investing. So we're always looking for the best locations that we can find. And how do you know if something's a good location? You want to look at first median household income in a 1 mile radius and a 3 mile radius, and see what that median household income looks like. That's a very important screen. You also want to understand, what are the industries that are around? What's the proximity to jobs? What's the proximity to nightlife and fun activities and things people want to do? Because if you start to understand that dynamic, you understand what the demand of the asset is going to be that's within proximity to those various different things that people want to be close to. So location is the first thing we look at, the most important thing to look at when it comes to multifamily investing. And of course, there's limits to everything. Howard Marks very smartly said that basically people have a bias when it comes to kind of quote unquote good assets and bad assets. Because if you overpay for a good asset, you can create risk. But if you buy a bad asset cheap enough, you can give yourself enough cushion to create a very interesting opportunity. So just keep
Hmm.
that in mind. Like, location's not the end all be all. You got to be careful, but location is the most important thing that we look at. And because at the same time, there's nothing you can do as an investor or an owner or an operator to change the location. It
Right.
is what it is, man. When you buy in that location, you better hope it's good because there's nothing that you can do to change the environment in that location. The next thing I would say would be the physical building, or kind of the quote unquote bones of the particular property. So what does that mean? The first thing you might want to look at is unit mix and unit size. So something that's all studios and one bedrooms, smaller, crappier units, that's going to be way less attractive than something that has all large 2 and 3 bedroom units. That's something you got to look out for. The layout of the unit is really important as well. What's the flow? Does it have walk-in closets? The size of the unit, that's all really important. Amenities is really important as well, because if a consumer or a renter is out there trying to figure out where they're going to live, they're basically comparing your property as a product. And they're comparing your product with neighboring products, and they're going to choose whatever product gets them the most bang for the buck. So, yeah, I mean, if you have a dog park, if you have a gym, if you have things like that, that's really helpful. And if you don't have those things, it's not the end of the world, but do you have the room to install those things? We're actually going to be installing a gym in our last deal in the next couple of weeks here. So the bones are really important as well. How dense is the property? Like, that ties into bones as well. The deal we just bought, I can't remember the exact density. I think it's lower density. It's 2 levels, and we comped it out against a deal that's just a block away. That's getting $200 to $300 less per unit per month, and it's like, wow, that deal even has renovated interiors, and we're done, but we're still doing that much better. Like, what's the deal? And one of the things with it is density. Like, this other deal is it's a 3-story deal, and people don't want to be on that third floor, man. If there's no
Hmm.
elevators or anything, So density, like these are all different, just kind of like very detailed factors that we look at to assess like what the bones are. Patios, people love having patios and fenced in yards. Does your product have it or can you install it? I know that's kind of a long diatribe again, but
Yeah,
just
no,
there's a
no,
lot
but
that goes
it's
into
all
really
great
thinking about what
stuff.
the bones
Yeah.
are of the deal.
No, it shows the level of detail that you pay attention to, right? And as LPs, we're not necessarily paying attention to that specific level of detail. And that's why we invest with guys that are doing that, right? And have the knowledge to know what details are important, right? Like what are these little details? And thinking about, hey, look, how is the ultimate consumer of this product feel, right? The flow of the units. Is it close to things that they can live? Do they want to walk up to a third story apartment where, hey, they forget their keys, they got to run up and down the steps again, and take groceries up the steps. Older people already automatically turned off. So these are things that we as LPs may not be thinking about, right? So I
You'll be
think that it
shocked
is.
too, even minor architectural things like the entrances into the apartment units, even minor things like that can really have a significant impact on the resident experience and the look and the feel. We've got a comp that's right across the street from us in one of our deals. And on paper, it looks like it'd be just as good, if not better. But the architecture, it looks and feels like a 60s era hotel where it's two levels and you just walk right to your door. Our deal has this architectural element where it's kind of pushed back in. So people have more of a private entrance to their own apartments. Sometimes little things like that really add up too.
Make a difference. Yeah, yeah,
Yeah.
sure. So now let's get into what should investors avoid. Now, what are we looking for as LPs in a multifamily? Hey, look, all right, so now we see what you're saying. All right, the thesis makes sense. Dentists, we're an analytical people. We're data people. We like to understand things. So what are we looking to avoid, right? How do we avoid making mistakes? What are we looking at in a particular deal or investment opportunity? What are the main things that we want to look at?
Yeah, there's a lot of different directions we could take this, and there's a ton of different things you could look at that are deal specific. Let's take a
Yep.
little bit different of a spin on this one because at the end of the
Sure.
day, when you invest in a deal, you're betting on the jockey.
Yep.
You abdicate a lot of trust and responsibility to the sponsor that you're investing with. So there definitely should be, before you even look at the deal, there should be a pretty healthy amount of sponsor DD that you do to get comfortable with the sponsor. And one of the things that you can look at right away, like I think this is a really good shortcut for people, is to understand the sponsor's fee structure, and that's going to allow you to understand how aligned the sponsor is going to be with you as the LP investor. So let's talk a little bit about fees because that's going to just kind of help tie all this together. If you're investing in a multifamily syndication, there's a certain market rate of fees that a sponsor typically should be charging. Usually, what I see, for example, for an acquisition fee, Johnny, let me know if you see anything differently. Usually, what I see on an acquisition fee might be something like a 2 to 3% acquisition fee. It might skew up a little bit higher if it's a smaller, more sub-institutional sort of deal. Might push a little bit lower if it's a really big institutional size deal. Something like the asset management fee is usually something like 2% of revenue collections. And then the promoted interest is usually something like 30%, meaning that once the preferred return is paid and the investors receive their capital back, the residual profits are split 70% in favor of the LP investors, and the sponsor gets a 30% promoted interest. Those are pretty good guidelines that I typically see in terms of like what market rate fees would be for a multifamily syndication. So one of the things you can do is look at those fees right away and try to understand like, okay, are these fees at market or are they not? And if they're not at market, just know that's something that might skew that's going to stack the deck more in favor of the sponsor. And the reason for that is because like when I think about alignment of interests, if I put my LP hat on, I want to know like what needs to happen for the GP to actually get paid. And the more a GP's compensation is skewed toward the end of the deal in the form of the promoted interest, the more aligned they're going to be with you as the investor. Because for them to make real good life changing money, They need to pick and operate deals that actually win and that actually make you money. But if they're charging fees that are above market, more of their compensation is going to be skewed upfront in the form of the acquisition fee. They might receive more along the way in the form of the asset management fee. So now you create a situation where it's like, shoot, this sponsor might make 50% of their compensation just by doing a deal, and if that's the case, their incentive to pick deals that actually win for you is lowered much
You don't even
more.
need to.
So yeah, really think about the alignment of interest, the fee structure. We could
Yeah.
talk about waterfall structures too. I know we're running a bit short on time here, but that's like a real good shortcut because you might see right away, like, holy cow, I mean, these fees are way above market. And at a minimum, that should be a yellow flag for you, if not
Yeah.
a complete red flag.
Yep. Yep. Agreed. All right. So yeah, this has been a great discussion. We talked about the multifamily cycles and how cycles can create fortunes, right? When this and I know I was being a little bit devil's advocate to a lot of things Tyler was saying. I gave him a lot of pushback, and I did that on purpose because we need a voice for LPs that have frustration with what things are happening. But having said that, we can also see and be objective is that conditions are getting really favorable for multifamily, right? So and this the trend is your friend. All of those sayings, I 100% believe this is a great time to be really considering multifamily because you can get in at great basis. Get in at a great point where you're just going to ride the trends where multifamily is going to become rent growth is going to happen. We know that this is going to happen. We know that supply and demand imbalance is going to happen. These are black and white things. And so it's just a matter of recognizing it, knowing that the best opportunities actually appear. I mean, when sentiment is the worst. Right? When every doctor, when you go to a party and you're talking to all your neighbors, all your other rich friends, and everybody's at a cocktail party talking about how much money they made on a syndication, and they're going to invest more, that's already telling you that it's way too late. This is a time when everybody is talking about it. That is when you should not be doing it, right? And when everybody is turned off and everyone's not paying attention, this is what creates the opportunities. I think Tyler did a great job of explaining why, and having selective optimism, right? I don't think that all multifamily is good, but certain types of multifamily are going to do better than others. And I think that this value add was very dead for a while because there was no spread between Class A and renovated Class B, but as Class A disappears, we're going to see a big gap between that happening again. And this creates tremendous opportunity for value add investors, which I know this is what you guys focus on directly is that. And underwriting and the sponsor matters more than ever right now, right? So I think that is one of the key takeaways I got from this discussion is that the underwriting really matters, right? Getting the debt, you commented on the debt, getting that part right. Is there
Definitely,
anything
Johnny.
else that anything
Yeah,
else
let
you
me
want to
let me
add
let me
before
just
we
add
sign off?
too, because if you kind of look back at this last cycle, the people who did get hurt is the people who are in short-term floating rate debt. Because I know plenty of people who did buy deals at the peak of the cycle, and the guys who levered more responsibly using long-term fixed rate debt, the valuation might be a little bit lower right now, but they're still clipping a coupon and they're still cash flow and they're still going to do really good on those deals. So
Yeah.
yeah, the debt's really important. The sponsor's really important. All these things are very important for sure.
Yeah, great. Yeah, great discussion. Great having you here again, Tyler. I want to thank everybody for paying attention today. Land the plane. Before we sign off here, Tyler, if people want to get in touch with you or learn more about what you're doing, what's the best way to reach out to you?
The best way would be to visit me on LinkedIn. If you just search Tyler Lyons Real Estate, I'm pretty easy to find there. I'm fairly active. So yeah, feel free to connect with me there and look forward to a conversation.
Very good. All right, guys. So if you got value out of this video, You already know what to do. As my 14-year-old daughter would say, smash the like button, share with your like-minded colleagues, share this channel with your like-minded colleagues, and click on the next video to keep the wealth of information growing, and you can take the walk of wealth with us. All right, guys, thanks a lot, and we will see you next time. Tyler, thanks for being here again, brother. Always a pleasure.
Thanks, Johnny. Appreciate it, man.